Welcome to the Techno Fundamental Report for June the 6th. In this business, if you're good, you're right 6 times out of 10. You're never going to be right 9 times out of 10. When you're building a portfolio, and this is according to Peter Lynch in his book, One Up on Wall Street, which is an excellent book. It's a stock at a time. Your goal is to get 10 profitable positions, but rarely does it seem to work out that way. It usually works out to be about 6 out of 10. Now that's if you're in an uptrending market. In a downtrending market, it's basically 0 out of 10. But I had a friend introduce me the other day to Emperor Hadrian, and interesting memoirs. I actually read his memoirs, and he was a head of the Roman Empire back in 117, and he was really big on controlling the borders of Rome, and he built his wall brick by brick. So it was just a kind of an interesting analogy. The Laffer curve, I think this is an interesting topic. It's a curve that visually shows the relationship between tax rates and the amount of tax revenue collected by governments. So think of it this way. If you had 100% tax rates, you wouldn't want to go to work. You wouldn't work. You wouldn't want to be predictive or productive. However, the revenues to the Treasury would be 0 because nobody's working. Now, if tax rates were 0, the Treasury wouldn't get any money either. So you've got to find that range where your tax rates don't discourage productivity. So keep that in mind as you vote in November. Value line geometric index. Now realize here that the geometric index is an equally weighted index of 1,700 stocks. So it's a very, very broad index. Here's the bear market that hit us back in 22, and you can see what happened to this very broad index. Now what's important to understand here is it's equally weighted. So in other words, every stock in the index is equally weighted with each other, whereas most indexes, the Dow, the S&P, the NASDAQ, are all market cap weighted indexes, so that the larger the company, the more emphasis it is in the index. So these indexes can be somewhat deceiving. But if you look at just the average stock, since the bear market of 22, the average stock really hasn't gone anywhere. But we are seeing a lot of activity in the NASDAQ and in some very specific companies. So it's kind of back to what Peter Lynch said. It's going to be 6 out of 10, not 9 out of 10. So you've got to find the right 6, and then the main thing I try to do is keep those 4 under control and minimize my losses in them. So we can see here with the NASDAQ, new high. We're seeing very positive trend here with the NASDAQ. This is being driven by NVIDIA. Here's the S&P 500, same story, new high. This is a uptrending market, looks like a bull market. Now here's the equally weighted S&P 500. So it's the same thing as the value line situation. The average stock is really pretty much moving sideways. Hopefully this changes and the market broadens out and increases its breadth. Now, interest rates, interesting enough, are really starting to kind of drop here. I've noticed yesterday that the 5-year Treasury broke below the yield on the 5-year Treasury broke below the 200-day moving average. So if we get the Fed cutting interest rates, I think that's going to help the small cap stocks greatly, and it's going to help the overall market. Now, the primary trend continues to be up. We're above the 200-day moving average, both for the S&P and the NASDAQ. So we're in good shape there. Now, another indicator we've been kind of looking at is what I call a mini yield curve. It's where I'm taking the 3-year Treasury and I'm subtracting the 3-month Treasury. Now, the 3-month Treasury pretty much mirrors the Fed funds rate. So if you're trying to get some type of market indication as to what the Fed may be getting ready to do or doing, you can see here that this relationship, back around the first of the year, we were of the opinion that there were going to be like 6 rate cuts, and there was all kinds of talk about that. And you can see what happened. This particular ratio broke down below the 50-day moving average, dropped dramatically, and The market had a really good first quarter. But then that all started to change when, the inflation numbers were just not improving. Now the inflation numbers do appear to be improving, and we're getting that break below that 50-day moving average. So keep an eye on the 3-month Treasury versus the 3-year. I think it makes sense. Volatility index, the VIX, this measures volatility, and it's also called the fear indicator. It's really been breaking down. In fact, recently it came down to a new low for the year. So the VIX is saying volatility is starting to slow, and that's a good sign. Aggression index, this is where we're comparing the NASDAQ to the consumer staples. So we're comparing aggressive to defensive. And as you can see here, it's breaking out to a new high here, and this is mainly due to the fact that the NASDAQ has been so strong. Now let's look at these 3 economic indicators. A lot going on here. Like I'm saying, here we have the 10-year Treasury also breaking below the 200-day moving average, which is saying that, it's just a change of character. It's like all of a sudden interest rates are starting to come down here. Now, oil, another inflation indicator, is breaking down as well. You can see here price of oil has moved down from, it got up to over 90, and now it's breaking down to around 70. Financial stocks pretty much moving sideways in here, but continue to look constructive above the 200-day. Now, I also wanted to mention here, this is I just happened to notice this, the Commodity Index Tracking Fund. So this is commodity prices. Man, they're really coming down. Now, that's got to indicate to me that inflation is really starting to slow, and hopefully we hit the Fed's target and we get some good news out of the Fed. However, with the small cap stocks, we have to realize here relative to the S&P 500, this is where I'm comparing the small cap stocks, the Russell 2000, to the large cap stocks, the S&P 500, continues to underperform. However, if we get a cut in rates, we're thinking this potentially could reverse itself. This is like around the first of the year when that ratio I talked about earlier, about 3-month versus 3-year, we got a nice rally in the small caps. Started to get a little excited about them, but they continue to underperform. But I think we should watch them, because if they start outperforming, that's going to be a very positive sign. So last but not least, let's mention NVIDIA here. The stock has been incredibly strong. The question to ask here is this 1995 where Cisco invented the internet? Basically, they invented the internet router, and it started a whole economic cycle, what we call a growth stock cycle, which is the best of all worlds for us. So with NVIDIA, we're hoping that this is the beginning of a new growth stock cycle having to do with artificial intelligence, but the stock is definitely in a strong uptrend. Market cap is now over $3 trillion, which means it's gone above Apple. So NVIDIA looks positive, $3 trillion company, so keep an eye on it. If you have any questions, please let me know. Thank you very much.